Good morning, everyone. So, who remembers what we studied yesterday? What we did yesterday? Who remembers? Topics. What topics did we discuss yesterday? Put it in the chat box. Let's see. Rapid fire. ERM. Okay. Risk and return. Yeah. Value. TS. ESG. I think you mean, right? Not TS. CPAR. Okay. Good. Good. So it was all about ERM, right? And then GoPro. Yeah, correct. So all those aspects we dealt with. Right. Today we are going to delve a little bit deeper into risk and return. Yesterday I had told you that higher the risk, higher the expected return. Right. So we'll look at it that what all types of investors are there, how what are the risks involved, and according to those risks, how we can mitigate those risks. Okay. In the book, the notes are not very, I would say, not in a not very comparable manner it is given. Okay, so I have prepared that notes in the Excel. I had told you, right? So that Excel also I had given to Madhuri to upload. So I will first go through the Excel only, and I think that should be enough, because I have created a table. Okay, this table in which we have the risks also. What are the risks and what we can mitigate. Now, if I show you how it is in the book, right? So the risks are given first, the description of the risks. In between, unnecessarily they have put the computation of returns. It should have been at the end. After the computation of return, okay, then see, after the computation of return for so many pages, then it comes mitigating factor. All those risks that was discussed in the first part, now these mitigating factors are given. So I felt it a little bit clumsy way of putting it. So I put it in a tabular form so that it is easier for me. What do you think? Which one will be better, this table or the book? Because accordingly I will take it up. Okay. So fine. What I will do is I will do it from here and then show it in the book also quickly. Means in the book, same thing is there. I have taken from the book only and made the table. Okay, that's a summary. There are three types of investors. Okay, risk and return we understood yesterday itself. If I go back to page 19, right, the relationship between risk and return we had looked at it yesterday itself. Now there are three types of investors. Okay, risk indifferent, risk averse, risk seeking. I am talking about investors. You can think about it in terms of a company also who's going into a new product line, new geography, etc., etc. But we understand more or less in terms of investment better the risk behavior. So that's why I'm telling investment. Okay. So generally the investor is which type of investor? What do you think? Risk indifferent, risk averse, or risk seeking? Means I, A, or S? What do you think? Means even before, just by the name, indifferent, averse, or risk seeking? What type of investors are there in the world? Most common. Correct. So it's the risk averse investors. In fact, risk averse are the logical investors. Why? Because that relationship that we discussed yesterday, right? That higher the risk, higher the expected return. Or conversely, lower the risk, lower the expected return, right? So there is a positive relationship between risk and expected return. Those investors are risk averse investors. They don't want to take risk unless there is a higher expected return. Okay, makes sense. This is very easy. Risk indifferent is an investor who does not care how much risk is there, whether it's higher or lower. They only focus on the performance or they only focus on the returns. All right. So let's say two projects are there. One is giving 10% return, another is giving 12% return. They are not even going to look at how risky the second project is. So basically they are not going to look at risk adjusted returns. Okay. They are not going to look at the risk adjusted returns. They are only going to look at the returns standalone. Risk averse investors will look at the risk adjusted returns. Okay. You got the difference? Anyone is confused? I'm taking it slow because it's important also. The difference between risk averse and risk indifferent is understood. Last is risk seeking. Risk seeking basically means that they are they would expect lower returns for higher risk. Okay, can this happen in real life, that an investor is investing in a risky asset and they are expecting a lower return? Can this happen in real life? Yes or no question. If you are finding too difficult to write 3 letters or 2 letters, you can write 1 letter also, Y or N. Okay, so this is illogical, it will not happen. But just to explain the concept to you, right, that what it means about a risk seeking behavior. How many of you have uh, seen the movie Zindagi Na Milegi Dobara? Hrithik Roshan, Farhan Akhtar, Abhay Deol. Have you seen the movie Zindagi Na Milegi Dobara? It's a great movie. If you have not seen, then you should see. Okay, not right now. After becoming CPA, you see. Okay. All right. So, what it was there in the movie, the adventure sports were there. Three friends were there, and they were doing adventure sports. So, in case of adventure sports, the higher the risk is, the more the people are willing to pay, right? So, in that case, because they are getting that thrill, right? So, in that case, you can think of it as risk-seeking behavior. Or in case of horror movies, right? The more it can scare you, the more you will give a better rating to that movie, isn't it? So in case of horror movies also, we are having that rush, right? Adrenaline rush. So the more it is, the more we are going to give a good rating to that movie. So that is sort of risk-seeking behavior. But in real life, in case of investments, it is not found. Okay. So these are the 3 types of behavior. Now let's come to this table. Hmm? This table, if you see, we have these risks, right? Interest rate risk, or it is also called yield risk. I put alternative names also so that in the examination you don't get confused. Market risk or systematic risk or non-diversifiable risk, non-market risk, unsystematic risk, firm-specific risk or diversifiable risk. Don't get bogged down by so many names. I have just given it so that in the examination you don't get tricked by the question paper setter, right? Credit risk is there, default or financial risk is there, liquidity risk, price risk, business risk. Oh my gosh, right? So many risks are there. How a person is supposed to do business, correct? But so many risks are there. We will understand what are the risks, what is the meaning of those risks, and how we can get over them. Okay, or is there a possibility to get over them or not? First is interest rate risk or yield risk. I have written here that it is the lender or investor's view. Investor, we understand. Why I am writing lender? Because if you are giving a loan also, then this concept applies to you. Okay, if you are giving a loan also, like investment is very easy, right? If you are let's say purchasing an FD or a bond, right? You from the market you have purchased a bond, right? So you are investing in that, so that will carry a interest rate risk. Now what is interest rate risk? Interest rate risk will happen on fixed rate bonds. Now this seems counterintuitive, right? Because generally if it is fixed rate, we don't have a risk, right? Our rate will not change, correct? It seems like in a fixed rate bond, it's fine, right? That's why we do FDs, correct? So that we can lock in the rates so that the rates don't go down in future. Even if the rates go down, we are not impacted, isn't it? What do you think? No, yes or no also? This is very strange. I think this is the most silent batch I have ever had. Okay, maybe because the number of students are also less, that's why. But you should understand that if such a scenario happens, that I I don't know whether I'm able to make the concepts clear or not, and whether you are engaged or not. Okay, so that's why I keep on asking questions, small questions, so as to get a feeling of how you guys are faring. Anyway, so I'll move on then. So interest rate risk basically means that in case the interest rates are up, right? Then the fixed rate bonds value will go down. Now, how does that happen? You may be thinking that it is fixed rate, then how does that happen? This happened to me also in real life. Okay. So I had purchased an FD of which was giving me a return of 7%. I had bought like 2 years back. Okay, I think 2 years or so. Then at that point of time, I thought I have done the correct thing because the rates were going down and down, right? But after that, the rates started going up. Okay. And it so happened that the rates went up till 8% also. So then, am I having any loss here? Because my rate is fixed at 7%, and right now I don't have any money to spare. So am I having any loss here when the rates have gone up? New FD rates have gone up to 8%. Correct. So that is a notional loss that I'm having. It's called opportunity cost, right? Because I'm losing. How? If I would not have done that fixed rate FD, if I would have done a floating rate, suppose I would have purchased a floating rate bond, then the rates would have gone up now. Okay. So what happens basically, how the calculations are done, I'll just show you a simple one. So let's say $1,000 is the nominal value of the bond, right? And the rate at which it has been entered into, what I was talking about was 7%. Let's say it's a two year bond. So first year it will be 70, next year also it will be 70. But what we saw is that right now the market rate is 8%, right? So then what happens if I'm going to sell this bond in the market? Will anyone purchase at $1,000 from me? They can purchase from the market itself, right? $1,000 and get 8%. This bond is giving just 7%. Will anyone purchase from me at $1,000? No, right? So what I have to do? If I can't sell at $1,000, what I have to do then? If I need the money, I will have to, yes, I will have to give a discount. Correct. So what I will do, I will calculate the intrinsic value of this. So it's very simple. It's like 1 plus whatever rate is there, and then for the 70 also divided by 1 plus the rate. Okay, this 1000 will remain 1000, right? Because it will be to the power 0. This will not get discounted, but this will get discounted and the 70 will also get discounted. Oh, this will be in third year. No, sorry. Second year. It will not come here itself. So this will get discounted divided by, or I can take both together because this will be at maturity value. So I'll take directly here 1070 divided by 1 plus 8% to the power 2, right? So this comes at 982. So the present value is coming at 982, right? Okay. So I don't get bogged down by this calculation. We will do it multiple times and I will explain it later on. What I wanted to show you is that as the rate increases, the market rate is coming in the denominator. And if something comes in the denominator, definitely if it increases, the ratio or the resulting figure will go down, right? So this is the interest rate risk, right? In case the interest rate is going up, the value of the fixed bond will go down. Okay. Then how do we mitigate it, right? So as I was saying, right, either we can invest in a floating rate bond, okay, or we can take derivatives. Now, what are derivatives? Derivatives are basically not the actual instrument or actual investment. Those are um, those are deriving their values from a underlying investment. Okay. What can be a derivative? A derivative can be a future or forward, swap, options, all those can be derivatives. What exactly are those? We'll discuss a little bit later. Okay. Mostly in the Forex chapter, we'll discuss it. Next is But those will actually be, if we enter into derivatives, those will save us from any future risk. We can convert our fixed rate bond into a floating rate one by getting into an interest rate swap. Okay, there are examples in the book, numerical examples. Once we solve them, it will be much clearer. Then we have market systematic or non-diversifiable risk. And second, so these two you can read together. And then second is firm specific risk. This will be very easy to understand. Firm specific risk is the risk if I am buying a stock of a company, right? Let's say if you are buying a share of TCS, right? And if TCS goes down or goes up, if TCS goes down, then it is a risk that you are having. How can you reduce that risk? How can you reduce that risk? What do you think? If I'm having one share of TCS only, that's a concentration risk also, right? On that share alone. So what should I do to reduce that risk? FNO, no, that will not be the first line of defense, right? That is there, derivatives are there, but we have a simpler method. We will diversify. Okay. By diversification, I mean that we will buy some unrelated stocks, right? In some other industry, let's suppose. I have bought TCS, or in the same industry or another industry will buy. Let's say I have bought TCS, then I will buy, let's say, uh, Snyder. Okay. I'm just giving some example. So we can diversify, we can buy more and more stocks so that we have a portfolio of stocks, not a dependency on one stock. Because what happens if TCS as a company faces some issue? Their major customer may go away, or there may be some lawsuit against them, and these things keep happening, right? In US, class action lawsuit is very famous. Means one person can bring down the entire company. So in that case, we should be prepared so that we don't have our exposure to only one single company. Okay. Market risk is what? Market risk is basically overall market, right? At an index level. So our market is measured by which index? Do you know? India. India is measured by which index? Very good. So it's Nifty, it's not Sensex. Okay, Nifty is the measurement of Indian index. So similarly, every country has their own index, and market risk basically means if the entire economy goes down and the market goes down, right? I think last week itself uh, the markets went down, right? Some Thursday, Fridays. So um, so in that case, what happens? We cannot diversify it, right? Diversification happens for individual stocks, not for the market itself. So what we can do, we can short sell indexes. Short selling means what? Short selling basically means that we don't have the index, we don't have the shares, but we are borrowing it and selling it in advance. Later on, when the prices go down, then we will buy it again and return the stock to the from whom we have borrowed. Okay. So that is short selling. Either we can do short selling if we think the markets will go down, or we can get into derivatives. Okay. Next is credit risk. Okay. So credit, let me increase the font, right? You might not be able to see it properly, right? Now is it better? So credit risk. So what is meant by credit risk? Credit risk basically means that what is the credit rating of the bond issuer, means the company basically. See, bonds are issued by company generally, and investors will buy those bonds. So the credit rating of the company will determine what type of interest rates they are able to issue the bonds with. In our individual scenario also, what happens if we go to a bank? Let's say two people are there. Virbal is there and Ayush is there, right? No, no, not risk of default by counterparty. Variable. Credit risk is different. It's related to the credit rating. So let's say two people are there, you only, Virabal and Ayush is there. So this is just an example. Don't take it personally. Okay. Yeah, CIBIL score. So Virabal goes and his CIBIL score is a little bit better. Let's say it is 800. And Ayush's CIBIL score is little bit deteriorated. It's say 400. Not little bit, it's very bad. Let's say. Okay. So just an example. Okay. So then who do you think will get a lesser interest rate? Virbal or Ayush? V or A? Virbal has a better civil score than Ayush. Who will get a better rate? Yes, whoever has the better credit rating, right? So this is that risk that in case our credit rating for it's not only for individuals, right? For companies also credit scores are calculated. So if the credit rating of a company goes down, then there is a risk that they will have to pay more interest rate. Okay. And this risk is more on short term bonds. Why? Because in the shorter term, the credit score can fluctuate, right? If it is a long term, then we will lock in the interest rate for a longer period of time. In the short term, again and again, let's say within 6 months, each 6 months we are having to reissue the bonds. Then again and again, we'll have to check as per the credit score where the interest rate is lying, what the market is giving, etc., etc. If it is a long-term bond, we will be locking it in. Okay. How do we mitigate this? It's simple. If your credit score is bad, what do? You make it better, isn't it? So what do? You try to do ratio analysis. You try to check out that whether you are meeting all the terms and conditions of the previous bond issuance, so that there is no risk, okay, or reduced risk. Next is default or financial risk. This is the risk of default by counterparty, what Virbal you were saying earlier. So default risk or financial risk, this we all know, right? The bad debt that we say, that the debtor may default or the borrower or the bond issuer may default, right? So what can be the possible solution? That you uh, lend to borrowers who have high credit scores, right? There is a second option also, which I don't personally like, is you increase the interest rate. Okay. You add a interest rate premium. Okay. Default risk premium. Now, it will help to a little bit extent only, right? Because if you are lending money to a low credit score borrower, even if you increase the interest rate, the risk is not going down, right? You are just getting compensated in monetary terms in case that borrower will repay the money. But default risk in itself means that they may not be able to repay, right? So adjusting interest rate or increasing it is not a very good solution, in my opinion. It should always be that we are lending money or investing money in a good high credit score. There are ratings, right? Triple A, double A, B, junk, etc. for the bonds. Those credit rating agencies will do a lot of analysis and give these ratings. Okay. So based on that, we should do. Next is liquidity risk. Okay. This is also one of the big risks. We don't think about it too much, but we should, because in future when we will require the money, we don't know. What is this risk? Basically means that whatever is whenever we are investing in security which is unlisted, okay, what can be an example? Not security, any investment which is unlisted. What can be an example? The best example of illiquid asset will be what? Can you tell me? Which most of the people in India or abroad also, they will do investment into illiquid asset. What is that asset class? Real estate. Yes. Arts and paintings, not many people will do. Yeah, property or real estate. So so those are illiquid, right? Real estate. but most people do in that because of multiple reasons, right? Returns also, then emotions are also there. Okay. So what can be the solution if we don't want to be in illiquid assets? In fact, if you are investing in a startup, what do you think? That is liquid or illiquid? L or I? If you are investing in a startup, let's say you are a angel investor. Correct. So it is an illiquid because you don't know when you will get an exit, right? When a new company will buy that startup, or the startup will go for an IPO. So those are not liquid, means that we can readily sell it and get cash, like stock, mutual funds, etc. So what we can do? Simply we can just, instead of real estate, there is something called REITs, real real estate investment trust. We can invest in that. That is more liquid than real estate itself. And or simply we uh, buy listed security, right? Next is price risk. Price risk is similar to the interest rate risk, that the price fluctuations, etc. And business risk is related, similar to firm specific risk, where related to a individual firm, there is a, if there is a issue, right, then we can do what, we can diversify, right? Okay. So this is it for the types of risk. I will show it to you in the book also, so that you are able to understand. Interest rate risk or yield risk, market or systematic, unsystematic, diversity, same names are there, right? Price risk. This one we'll do, how to calculate, we'll do with numbers, right? So that you are able to understand properly. Mitigation strategies also. Whatever is there, you will find those in the table also. Okay. Let's go to calculation of certain return formula. Now from here on, you will see that we are going into delving into numericals formula. All right. Some formula you will have to remember. Okay. So I put it here also. But anyway, that is in the book also. So we'll do it from the book and we'll try to solve the numericals here. Okay. So first is stated interest rate. What is meant by stated interest rate is simply what is the contractual rate, right? In the bond, it will be mentioned that what rate of return it will be, the interest will be paid off. This is always annual, guys. Okay, this is always annual basis. It will never be on a quarterly or semi-annual basis. Okay. Next is effective interest rate. Now, effective interest rate basically means that for each period, how much it is. Means if it is payable quarterly or payable semi-annually, then what will be the interest rate? Now, let us just solve this. Okay. So 10,000 promissory note, right? Whatever is given, promissory note, bond, etc., etc. Stated rate of 10%. This is per annum, right? Per annum means annual, and is due in 1 year. Okay. Bank charges a loan origination fee of $75. This is what? This is like your processing fee. Do you know what processing fee or processing charges are? Anyone who doesn't know processing fee or processing charges? Okay. And there is a stamp duty also. Okay. So now they are asking us to calculate the effective interest rate. This example is not very good, let me tell you, because they should have told either semi-annual or quarterly basis. Then only we would have got a better example where effective, because right now it doesn't seem like effective interest rate. It seems like stated rate only. That's why I have put an example on my own here. We will look into it, okay, a little bit later. But let's solve first this one. So let me go back to Excel. So many things are there. Yeah. I would have put many things, Don't get bogged down by everything, okay? So let me do one thing. Okay, let me put the new sheet. Date today is 3rd March. So I'll put 3rd March. Okay. These summary sheets are there, but whatever we are solving in class, I'm just putting it here. Okay. So 10,000 promissory note. So face value is $10,000. So what we are doing, effective interest rate. Face value is $10,000. Stated rate is 10%. Okay. Next, bank charges and stamp duty both combined. So I'll just write charges. Both combined is $125. Now, right now, if I'm taking a loan, right, or I'm issuing a bond, whatever, right? So what is that I will be able to use? Will it be $10,000 that I will get in cash? Correct. So it will not be $10,000. We'll be getting lesser. Net of charges, brokerage, etc. Correct. Yes, correct, Rajeshwari. So we will calculate the net inflow 10,000 minus 125 and outflow, but the outflow will be on face value only. Always the interest will be calculated on the face value. So the effective interest rate will be 1000 divided by 9875. So 10.13%. This is higher than 10% because of the lesser inflow, right? So this will be higher than this. Okay. Anyone has any doubts in this? Next is annual percentage rate. Okay. So similar example, let me just note it down. This is the better example where you will understand better. So stated rate is 8%. So we are going to calculate first the net inflow outflow, right? So it will not be 8% because here the payment period is semi-annual. What is meant by semi-annual? We will be paying it twice in a year. 6 months divided by 12 months. 400. So first we will calculate effective interest rate. Okay. So this is periodic. Okay. Effective interest rate is periodic in nature. So this is not for the full year. For the full year, we'll calculate annual percentage rate. Annual percentage rate, what we'll do? We'll take the effective interest rate and multiply it by the periods. Now I'll take a pause. Anyone has any doubts on this calculation? Effective interest rate and annual percentage rate. Now you understood, right? Why I was saying this example is not good, because it was at an annual basis, right? Effective interest rate is actually periodic basis. Annualized or annual percentage rate is annual basis. Okay. Not rocket science, but you need to know. Now this is where things become a little bit tricky. Effective annual percentage rate, because here we are going to use to the power and all those complicated stuff, right? So effective annualized percentage rate, the will not go to the formula, will go to the question directly, right? So same question, okay? Face value is given, stated rate is given, and okay, let's not say charges. Okay, let's go to EAR. Let's just say stated rate is 8%, semi-annual rate, yeah. Calculate the EAR. So the formula is 1 divided by 1 plus the percentage percentage obviously divided by 2, right? Means into 6 by 12, and then whole to the power 2, 2 because to the power 2 we did because of semi-annual 2 periods, and at the end we'll divide it by -1. Okay, 1 minute. I think it's not 1 divided by. So the formula is 1 plus the rate basically what we took the periodic rate, basically the effective interest rate, periodic effective interest rate we are taking, that is 4%, to the power 2 because 12 by 6, and whole we will take and do a -1. So let's say another bracket I will put here so that it's more understandable. Yeah, it is a little bit complicated, but are you getting it? At least right now when I'm doing it, are you getting it? Guys, yes, no? Okay. So this is the only one that is a little bit complicated. You will have to do it like few times to understand it. Okay. Simple interest is very simple. So simply you will take the rate, no to the power, etc. You just multiply it with the number of years. Okay. So it's very easy. Compound interest is where we do to the power. Let's say $10,000 is the amount and 8% is the rate for 2 years. So what we will do? 10,000, 1 plus 1 plus rate to the power 2. Now this can be solved a little bit differently also. Okay, so compound interest, same example will be there, face value and number of years will be 2. 2 years. Okay. So now what happens, how we can solve? So first year, our interest is this much. So what will be our balance? 10,800. Next year, compound interest. So compound interest means interest on interest. So the interest rate will be put on not only the face value, but on the interest part also. So this plus this 11,664. And if you see with the formula also, it's coming to 11,664. So you can do it like this also. It will be easier, but I leave it up to you. Okay. Then we have different types of premium, risk premium. We have a risk-free rate. Okay, if you go here, the real risk-free rate is there, which is called treasury bond rates, etc., where there is no risk at all. In case of government bonds, right? There virtually there are no risks. Inflation premium, we will be adding. Inflation premium means simply because of the period passing by, right? Inflation, we all know that as we pass, we progress, the general price levels will go up, right? This is what ordinarily happens. So that is why if there is a longer period, we'll have an inflation premium also. Then what are the risk premiums? First is interest rate risk or maturity risk premium. We had discussed it, right? Fixed rate bonds will have this interest rate risk also. Liquidity risk will also be there, that if it is illiquid, the more it is illiquid, the more rate of return will be added. And default risk premium, we had discussed this, right? Here, let me show you. Default risk, I had told that how we can mitigate. One of the options is that we adjust the interest rate. So how we adjust the interest rate is by adding this risk premium. Okay. Mitigating and controlling we have discussed already. Currency exchange rate risk, right? Or it is called FX, Forex, right? Forex becomes a little bit tricky. Why Forex becomes a little bit tricky? Because in case of Forex, you have to understand that in case of Forex, you need to deal with multiple currencies, multiple countries, and how the How the quote is given also matters. So what exactly it is, let us try to understand. Okay. Trade factors are there. Okay. Okay. Do I have a, let me see. I have a summary for this also. Hold on. FX. Yeah. Hmm. So trade factors, what are trade factors? Inflation, income levels, government restrictions, everything will impact the forex rate. Okay. So domestic levels are directly related to foreign currency value. If the domestic inflation is higher, foreign currency will also become higher, because wherever inflation is higher, you know, right, that wherever inflation is higher, that country's currency will fall in value, because people will try to invest in some other currency where the inflation is lower. Okay. If the income levels is higher, then we are becoming rich, right? Then we will try to buy local product or imported products. What do you think? When people become richer, they try to buy local products or imported products. Few of you may be doing CPA also, so that later on you can buy imported products. Huh? Okay. So, so what happens in that case? Because they are buying imported products, so their the foreign currency will go up because of the demand, right? And if foreign currency goes up, the relative domestic currency will fall down. Okay. If one currency goes up, obviously the other currency falls down, because it's a relative rate that is quoted. And government restrictions obviously will impact the rates. Um, Financial factors are there, interest rate. If higher interest rate is we are getting in a country, then more and more people will try to invest in that country to get more interest rate, right? Let's say in US the interest rate is 2%, in India it is 8%. Then where do you think US investors will invest? US or India? Where will they invest? US or India? The interest rate is lower in US at 2%, and the interest rates are higher um, in India. So where they will invest, where they will get more return. So it will be India. So if they will invest in India, the dollar will go down or go up. What do you think? Dollar rate I'm talking about. Correct. Dollar rate will go down because INR will go up. Right? They are demanding more and more INR because they want to invest in India. And in India they cannot invest in dollars, right? These are some factors that will impact the foreign currency. Okay. Let's go back here. This is fine. So types of exposures are also there. So let's go back here. So we have got transaction exposure, we have got economic exposure, translation exposure. These are nothing but risks, the types of risks that are having in Forex. So we will discuss them one by one. Mostly we will be discussing about transaction exposure. Transaction exposure means related to one individual transaction. Okay. Whether we are having an account receivable or accounts payable. Okay. So if we are dealing with exports and imports, right? You might have heard this terminology a lot of times, right? Exports and imports. So let me just check what all things are there. Everything is covered here or not. Money market hedge, yes. The question example is there of money market hedge. Currency options is also there. Currency swaps is also there. Great. Economic. Okay. So let me go up, back up. So some examples are also there. Good examples are there. We'll solve them. Okay. Where were we? There. Here, right? Transaction exposure means that on an individual transaction, whether we are gaining or losing out, right? Why we will gain or lose out? Let's think about from a US entity, right? Because in the examination also, your domestic country will be what? US or India? Correct. In examination, the local country or base country will be US. Okay. So let's say US company is there and they are doing business with Japan. All right. Japan yen is the currency. So in case they are selling goods to Japanese customer, what will they have? They will have accounts receivable or accounts payable, AR or AP. Correct. I know it's a basic question, but why I am asking? Because Forex is tricky. Okay, these basics need to be very, very clear for you guys. So AR is there. Now, if we have AR, what are we afraid of? We will receive the money in yen, right? Because the Japanese customer will pay us in yen. They are not going to pay us in dollars. So if we are going to get in yen, what are we afraid of? Yen going up or going down? What are we afraid of? Yen going down, right? Because we are going to get in yen, and if it goes down, then we'll get lesser dollars when we convert that. Okay. So why this is important? Because this will set your tone for the question, to answer the question, that what you are afraid of, means what is the risk basically. In case of AP, it will be the exact opposite thing. Suppose we have a vendor in Japan and we are buying from them. We will have AP, right? Now, as of the settlement date, if yen is going up, then it will be a gain for us or loss for us. In case of AP, we need to pay to the Japanese vendor. So if the yen is going up, we'll have a loss or a profit. Correct. We'll have a loss because we'll now have to shell out more dollars to buy the same quantity of yen, right? So now you get the understanding, right, that what is the type of risk that we are talking about. Whenever we get into export or import, that is dealing with any other geography, then we have a issue. We have a issue as in we have a risk. Okay. All right. Let's take a break and come back after, let's say, come back at 12:40 and continue this. Okay. We will continue this and conclude this Forex till the Forex chapter. Okay. Yeah. Okay. So, yeah, transaction exposure. That is transaction exposure. If we are talking about just one transaction, right? And mostly we will be dealing with transaction exposure only. There are various methods to go about and look into transaction exposure. We'll be looking into it one by one. What are all the methods by which we can mitigate it, basically? Because our main motive is to mitigate it, not to think that how it is originating and all. Origination is simple. We know that how it is originating, right? So next is economic exposure. Economic exposure is regarding the overall domestic currency, how it is reacting to the worldwide demand of domestic goods. Okay, what we discussed a little bit while back, right? That what happens in case imports are going up, what happens if exports are going up, right? I'll explain it to you further. Let's say in case of US is not okay. Let's say US dollar is going up, right? US dollar is going up. Then a person from China will buy more of US goods or less of US goods? What do you think? A person from China will buy more of US goods or less of US goods? Yes. So they will buy less of US goods because it has become costlier for them, right? It has become costlier for them. Similarly, if the US dollar falls, then opposite will happen uh, and the Chinese folks will buy more of US goods, right? The exports for US will go up. Okay. So same thing is written here. If domestic currency is up, then foreign imports will be up. If domestic currency is down, foreign imports will be down. Translation exposure is simply related to foreign subsidiary, right? If we have a foreign subsidiary and we have to consolidate it with our books, then what we are going to do? If we have a foreign subsidiary, we have to consolidate it with our books. We cannot consolidate it directly, right? Because it will be a different currency that the foreign subsidiary will be using. So we have to translate it to our own US dollars. and with that translation there will be a risk of change in the values. So because of that there is a risk which is called translation risk. And transfer pricing is simply if we are having transactions in between parents and subsidiary or between sister concerns like various subsidiaries itself, then we need to set a transfer price. Okay. All right. So now we'll go to the methods. First is netting. Netting is very simple. Okay. What we can do is the Japan example, right? I told that we have a Japanese customer and a Japanese vendor, right? So if we have both a receivable and a payable, AR and AP, what we can do is we can try to have both of them at the same date, right? Means if we are having both the payable and receivable on the same date, then what happens? We'll have just a net exposure, right? That is called a netting. Let's take an example. Let's say I am supposed to get from Rakuten, I am supposed to get Rakuten is a customer, so I'm supposed to get from Rakuten in Japan, let's say 1 million yen. Okay. Now I have another Japanese company, let's say Okinawa, who is our supplier. So to Okinawa, I need to pay, let's say 600k yen. If I put it on the same date, then what happens? That 600k will be netted off and the net exposure will be only of 400k instead of the entire 1 million separate and 600k separate. Okay. Yes. So natural hedge. So it is natural because we are not doing anything. We are just keeping the dates at the same time. It is not complicated at all. Okay. So netting is quite simple. Now comes the complicated part, which is hedging. Basically, short-term hedging. So we will discuss this, but instead of discussing here, it will be easier to do the examples itself. Okay. Especially of money market hedge. Money market hedge is a little bit tricky. Without the example, you will not be able to understand. So, but simple things first we will understand. Buying forwards or future, what it means. Okay. Buying forwards or future. Forex gain or loss will be involved to the extent of the part that is not getting netted off, right? In my example, 1 million and 600k was there. 600k is getting netted off. So 400k is still there, right? On that, foreign Forex gain or loss will be there. You got it, Parth? All right. Okay, coming back. So, yeah. So we can play in forwards or future. Now, what are forwards? What are futures? Futures are standardized contracts. The FNO. All right, futures and options. You might have heard about it, right? So futures are standardized contracts by which we can buy or sell futures, and we are just trying to trade on the future value of a stock. In this case, we can do it on a future value of a currency. Forward is a customized contract. We may go to a bank and say that, see, we have a contract of getting 1 million yen from our customer Rakuten Japan, and I want to hedge myself, right? So what I can get into a contract with is I will buy a forward that in the future, I will sell a forward that in the future you will give me at this predetermined rate, right? The bank will give it at the predetermined rate because since we are going to receive 1 million yen in future, what are we afraid of? Yen going up or yen going down? Correct. So we are afraid of yen going down, right? So if we are afraid of yen going down and we can lock in the rate, then we will not be facing that issue, correct? But then the question comes that why will the bank do that? Can you think of a reason why will the bank do that? Why will the bank get with me into such a contract that that they will give me a predetermined rate? Very nice. Okay. So basically, see, what we are afraid of is the foreign currency going down, right? Now they might be thinking that as per their estimates, the foreign currency will not go down. In fact, the foreign currency is expected to go up. All right. So in that case, they will do this thing, right? And they will gain. Correct. Very nice. So that is forward and futures, or there can be options, right? We can buy a put option. In case of a put option, we will gain when the prices are going down. So we are taking opposite position, right? If the currency is going down, then we will gain in a put option. So option and forward or future, FNO is simple. Okay. So in case of AR, we will buy a put or sell a forward or future. In case of AP, it will be the opposite, right? We will buy a call or buy a forward or future. Now the problem comes in money market. I'm not going to tell you what we do in money market. We'll look at it in the book and we will solve it on the Excel. That will be the easier part. That will be the easier case. So let's go here. See, futures contract, right? So what the example is given here is the company is buying crates from Mexico. So they have, first of all, you have to understand, is this a question of AP or AR? So company is buying crates from Mexico, right? So is this AP or AR? What do you think? Correct. Since we are buying, we are importing, right? It is AP. So when they buy, they incur a significant liability in pesos, obviously at spot rate 0.10. Now company fears pesos going up, right? Because it's a AP to 0.20. So they may enter into a future contract which will allow them to buy it at 0.10 only. Now later it may go down also to 0.05. All right, we don't know that. So that to safeguard ourselves, we are trying to hedge ourselves, right? That it may go up. So this is fine. Futures we have understood. Money market, right? So now let's uh, with a very cool mind, let's try to understand this. Okay. So Duffy's Discount Pinatas, the company name, has a payable due to its Mexican supplier. So supplier means AP, right? In the amount of 1 million pesos in 90 days. Okay. So we have to pay 1 million pesos in 90 days, right? Current exchange rate is 0.08 per peso. So that is also fine. This is called spot rate. Mexican interest rate are 16%. Okay, that's also fine. Duffy has 1 million in excess cash. So that's fine. And money market hedge. Now let's go to the Excel and try to solve it. 3rd March Excel. So I will write the page number, right? So that it will be easier for you. Illustration 13, B133. Illustration 13, B133. So I use Excel because I'm familiar with Excel. You can use a paper or calculator also, your choice, right? And in Excel, we get formula also. So pretty much nifty. I had used Excel only in the examination also. So, yeah. So what is the payable? AP is 1 million pesos. Okay. Yeah. Now days, so period is 90 days. Then spot rate is 0.08. So 0.08, see, this is a direct quote. Guys, please pay attention to this. $0.08 per peso. This is a direct quote, means per foreign currency it should be. If it is not per foreign currency, then we cannot multiply. We will have to divide it. Okay. Mexican interest rate is 16%. Let me put that also here. Mexican interest rate is 16%. So what we are basically going to do here is, first of all, we are going to discount this. Okay. Step 1. Present value we are going to calculate. So 1 million pesos is there. Just now we had discussed, right, how present value is calculated when we were doing stated interest rate, etc., etc. this divided by 4. Why? Why divided by 4? Because it's 90 days, right? So it means 360 divided by 90 will go to 4, correct? So this is the, in pesos, this is the present value. Okay, what we are going to do now, we are going to purchase. Step 2 is purchase the present value. Whatever present value is there, we are going to purchase at the spot rate. We know the spot rate. So this is what? Dollars. Okay, this many dollars we will have to pay to buy this many pesos. Okay, and then step 3, invest pesos in bank, in Mexican bank. This is step 3. So what will happen? We will invest the pesos in Mexican bank. After 90 days, maturity value will be how much? 961 into 1 plus rate divided by 4. See, 1 million pesos. We will get it from the Mexican bank and we'll pay it off to our vendor. Now what we are doing basically here is, we are right now spending $76K and we are removing our Forex risk, right? Any doubts on this, guys? This is the money market instrument. It is a little bit complicated, but I hope you got it clear. Anyone has any doubts? Stepwise we have done, that's why. So let's complicate it even more, right? So let's go to illustration 14, where we are talking about borrowed funds. So we don't even have funds. Here we had funds, right? It was written we have 100K. So what we are going to do, basically, little bit it will become more complicated. We will borrow the fund also. So let me put this illustration 14. So how it will go? Basically, what additional is written, it's the same question, but the US interest rate is 6%. So we'll have to borrow it at the US interest rates. Okay, that's the only additional information. So what we are going to do, there will be a step 4, correct? Or step 2B. Okay, so if you think about this as step 2A, so we'll have a step 2B, that we'll have to borrow the present value in dollar terms. So this, right? Not step 2B, right? We'll borrow the present value, but step 4 will be there. Yes, step 4 only. Step 4 will be there, that we will pay back or repay US dollar USDL, right? USD borrowings. So what are we going to pay back? This multiplied by 1 plus the US rate divided by 4, don't forget, because these are what stated rate, right? So we need to repay 78,000. So even at the after 90 days, we will have to repay 78,000, not in pesos. So still we have been able to lock in on the risk, right? You got it? So one more step. If there is a borrowings also involved, we don't have excess money in our hand. Okay. If any doubts are there, please let me ask. Similarly, in the same way, there is a if we have a receivables, right? In case of receivables, it's just the opposite, right? We have a receivable of 1 million pesos. So what we are going to do basically, so what we will do is we will sell off the present value, or we will borrow the present value today in pesos and convert them into whatever money is coming right now in dollars. Okay, later on when the maturity comes, then we are going to repay in pesos, but from where that pesos will come, that will be coming from our customer, right? Our customer will pay us in pesos and we'll pay to the bank in pesos. Okay. I'll take a pause. Any doubts? Please let me know. Nothing? Okay, great. So moving on, we have options, right? I told you, no, options also we will be doing the questions. So let us do the question. You will understand that what is meant by options. Okay. So we have a payables. So we have a supplier 1 million pesos. That's fine. Spot rate is 0.08, and they are thinking that the peso will go up, right? Because we have a payable, so we'll be afraid of payable. So what we can do, we can buy an option to take the pesos at 0.08 per peso only. Now, why would anyone give us this option to buy it at a fixed rate? It's an option, right? We are not mandated by it. In futures or forward, we are mandated. But here, if the value of the peso is going lower, like 0.07 or 0.05, then we are not bound to buy it at 0.08. Okay. So means the downside is protected and we have upside. Then what do you think? Why this is going to be done? This is going to be done because option premium is charged by the bank. Okay. They charge an option premium so as to give you the option to buy it at a higher rate, and you will be gaining if the rate goes higher, and if the rate goes lower, you will not be losing. So let me explain that with this example. That will be easier. 135. Okay. So let's note down the things. I think it is similar things that are written here also. So they are afraid, and the exercise price means at the price at which we can exercise the option. Okay, at which we can buy it. Exercise price is also 0.08. Premium is 0.005. Okay, this is all per peso. Okay. Okay. Now let's say on the date it actually increases to 0.10 after 30 days. So what will happen? We will buy at 0.08. That means we'll have to give $80,000, correct, to buy 1 million pesos. But in the market, from the market, if you would have bought, then at what rate? 0.10 it will be, right? We would have to pay 1 million. So our gain is 20,000. But this is not our net gain because we paid a premium also, right? So our net gain, so this will be like inflow, okay, and net gain after premium will be 20,000 minus 5,000. Is it clear, guys? Is it clear to everyone? It will be clearer when I give a second scenario. So let's say the second scenario is where the price did not go up. It went down to 0.05, right? So if I buy from the market, it will be 80,000. Sorry, if I buy from the as per the option, buy as per option. So my outflow will be 80,000 from the market. At what rate I will get? 50,000. So what do you think? Am I going to buy from the option? Because I have to pay 80,000 as per option, right? But from the market itself, I am getting at 50,000. So we are not going to buy from the option, right? We'll let it lapse. Okay, we'll not exercise it. So what will be there is no gain or loss from the option because we are getting it lapsed. Premium we still have to pay. So our net loss will be 5,000. Okay. Our net loss will be 5,000. Is it clear now? Same goes for receivables. So this also, if you see, let's do some annotation. So same, we are owed 1 million pesos in 30 days. Current rate is 0.08. So what am I afraid of? Dollar going up or down? This is a receivables case. So am I afraid of dollar going up? Sorry, not dollar. Pesos going up or pesos going down? Correct. So we are afraid of pesos going down. So 0.08, so that is what is written here, that it may go down to 0.06. 0.05 is premium, so they get into this option. So spot rate is 0.06, option is 0.08, premium is this one. So net option price is 0.075. Our 60,000 will be the outflow, 75,000 will be the inflow. So net inflow or net gain is 15,000. It is also called net preserved value. Okay. So pretty simple, right? Premium is not counted in finance while evaluating in the money out of. What do we need to do in PAR exam for calculating? We will have to calculate, right? Because it is not sunk cost right now. Correct. We have to consider it as part of our net net gain or loss. It is sunk cost only when it is paid. Okay. Right now, when we are evaluating the option, it is not a sunk cost. So in case of bar, you will have to consider it. Okay, just remember this. Then we can have currency swaps also. Currency swaps means just like interest rate swaps. In interest rate swaps, we swap fixed rate versus floating rate. In currency swaps, we will swap one currency with another. Swap means exchange. Okay. So this example is there. Very simple example. So end of quarter one. Now, where is that? First quarter. Second quarter is where? In first quarter only it's written, right? Okay. Let's try to solve this. Okay, let's go here. Page number 37. So we have 1.5 million. What is this currency? I don't know. Zloty. Poland currency. So we have 1.5 million zloty. We are talking about quarter one because that's what is being asked in the question. 1.5 million zloty and USD is $500. Okay. So now they are going to do this. Now exchange rate at quarter one was 3.25. This is good. 3.25 zloty per dollar. Now guys, is this a direct quote or an indirect quote? Because as I said earlier, a direct quote is basically when we are having per foreign currency. Here is it per foreign currency or per dollar? Yeah, it is an indirect quote because it is per dollar. So we cannot multiply this with zloty. Okay, if you want to multiply with zloty, we will not be able to do that. So what we can do, either we can divide it with this or we can multiply it with dollars. So what I'm going to do is I'm going to divide it because in questions generally the foreign currency will be given, not the what do I say, dollars, right? So this divided by this, we got 461 and 500 dollars are there, 500K. If you subtract it, then you will get 38K. So that is the benefit, okay, in the swap, because whatever rate is happening, based on that we will get to know whether the swap is beneficial or not. Okay. because we are getting the money in zloty, right? I am talking from the US part, so I'll write that US viewpoint, US party viewpoint, right? Because US party viewpoint, because we are in the US, right? Means we are not in the US, but we are studying for the US. Okay, why loss will be there? Oh, yeah. From US party viewpoint, right? So US party is receiving zloty. So if they are receiving zloty, they are receiving this much, 461, whereas they have to pay this. So this we have to pay, and this we have to receive. So this will actually be a loss, because we are paying 500k and we are receiving 461. Okay. Yes, correct. Okay. Leading and lagging. Leading means that wherever the currency rate means, in case of let's say in case of the parent subsidiary relationship, or subsidiary relationship, if the currency rates is favorable in one subsidiary, we'll try to lead in that subsidiary, and we'll try to lag wherever the currency rates is weak. Now this is interesting, cross hedging. Okay, so cross hedging basically means that in case we don't have a hedging instrument for a currency, I'm just making up some example. Let's say we have a vendor in Nepal, hmm? or we have a vendor in Bhutan, okay, and we don't have any hedging instrument, derivative instrument for Bhutan, and we will see next step that which country has a positive correlation with Bhutan. We'll see that Nepalese currency has a very high positive currency correlation with Bhutan, and in Nepal there are derivative instruments. So what we will do, we'll go into a cross hedge. Since we don't have an option available for Bhutan, we will go into a hedging for Nepal currency, and the Nepalese currency, whatever we gain or lose, that will offset to some extent the loss from the Bhutanese currency. Okay, are you getting it? Currency diversification very simply means that we are going to interact with, or we are going to export and import from various countries. So just like stock diversification, we understood today that we are going to buy a lot of stocks. Similarly, currency diversification means we are interacting with a lot of countries, so that it is automatically there is a diversification. If one currency goes up, another goes down, it is offset to some extent. Economic exposures. So as I was saying, right, transaction exposures are more into our syllabus, more asked in the examinations also. So economic exposure, it is much more difficult. All right, economic exposure means that we are going to change our sales or purchases itself based on currency. Now, do you think most of the companies will do this? That they will decide where to sell and where to buy from which country based on the only the currency rates? Will they do that? They won't do that. Okay, generally they won't do that, because these are strategic decisions, not only based on the currency rates. So restructuring means we are going to change our sales or change our expenses based on the currency rates is not going to work generally, but this is the option to mitigate any economic exposure that can happen. Okay, all right, I think we have come to an end of this module. We will start off on the next module next week, which is related to law of demand and supply. Okay, so economics will be in the next week. Economics is also very interesting and very much required for your examination perspective also, and from your real life perspective also. Okay, so thank you. Let's connect next week. Please come back with your with after doing revisions and all. Okay, thank you. Bye bye.